1031 refers to Internal Revenue Code section, which is 1031, and ironically most of the 10 prefix code sections refer to tax deferral opportunities. 1031 specifically relates to investment real estate. So basically the government's saying that if you sold a piece of real estate that you had utilized in the past for investment purposes, you have the ability to kind of roll your gain forward into a new property purchase. And you effectively defer any historical capital gains that would have been due at the time of sale, roll them into the new investment and defer it until that investment is sold. So at some point down the road, you're going to have hopefully additional appreciation from that property as well as your historical deferred gains. And at that point, pay the capital gains tax. Now, if the law hasn't changed, you could roll it again, you could roll it again, you could roll it again. And there's a lot of discussion and dialogue about, from an estate planning standpoint, there may be advantageous to do that, because if you keep rolling these capital gains forward until death, the government gives you what's called a step up in basis. Basically, they say, what's the current market value of the investment real estate at death? And that's the basis, or the tax gift, if you will, to your heirs. So assuming you don't have an estate tax, nobody's going to pay any capital gains tax on it as well. That's the simple aspect of it. Some of the confusing things are there's a lot of rules, as you would expect, with an Internal Revenue Code regulation and commitment. And so a couple of things that you need to keep in mind. They talk about like-kind exchange, and oftentimes that confuses individual investors. It doesn't mean that if you sold an apartment building, you have to buy an apartment building, or if you sold a piece of raw land, that you have to buy a piece of raw land. Pretty much any type of investment real estate will qualify as a like-kind exchange. So it's a much broader category. It's just really real estate to real estate. And that could be very effective. You think about people that maybe owned some property that wasn't producing income. Now they're later in life and they're looking to generate income during retirement. They could move that raw land into like an apartment building investment and generate some cash flow from rent. The other things you need to pay attention to is a lot of people make the mistake of deciding to look at a 1031 transaction or a deferral once they've already had a closing on a property. And that it precludes you from actually even attempting to do it. You have to actually, before you go to closing, identify an intermediary. Usually they're referred to as a qualified intermediary, or QI. The QI kind of acts almost like your escrow agent or trust officer, and they just hold title to your property till you decide what you're going to exchange it into. Second thing that you have to pay attention to is you only have 45 days from the day of closing on the sale of your current property to identify replacement properties. And you can identify multiple properties during that 45 days, but you only have a 45-day window to basically inform your QI, this is what I'm looking at and considering. And then after that 45-day window terminates, you have up to 180 days to actually make a decision to go forward and purchase. Of course, if you do, you roll your gain forward, assuming you met all the parameters. But if you didn't, you're going to get subjected to a gain. Other issues you got to watch, you got to make sure you're buying a property of equal or greater value. There are some rules related to debt. So for example, if the building you're selling had 50% debt on it, the new purchase has to have at least 50% debt or greater. So you run into a few challenging points there. But extremely attractive methodology to defer tax. I mean, if you think about in today's world, a lot of people may have historically purchased a building for $4 or $5 million 15, 18 years ago. Today it might be worth $10 million, and their thought process is a $10 million sale. I paid $4 million originally, I must have a $6 million capital gain. What they're ignoring is their CPA probably very effectively took advantage of depreciation schedules. So they've actually reduced their original basis from $4 million down to sometimes nothing, or maybe only $1 million. So their gain might be quite a bit larger, $8 or $9 million. Second thing that happens is, depending on the level of depreciation that was utilized, sometimes there's a recapture of some of that accelerated depreciation at sale, and that can get taxed at ordinary income tax rates rather than the capital gains rate, which is now at 20%. State and federal, you might be at 27, 28% capital gains tax, but ordinary income could be in the 40s in some cases. Or if you're unfortunately one of those residents of California, now you're looking at just capital gains tax alone can get up into the mid 30%, almost up to 40%. So the deferral is very attractive. You've got your full $10 million of capital rolling forward into a new investment, probably generating income at a higher level than what you were from the prior investment. And then secondarily, or I should say as an alternative, you would have only had maybe $7 million of proceeds that you had the ability to invest if you had to pay a $3 million capital gains tax.